Good morning. I'm Tim Nyland. Food companies are in focus today. Food companies have said they are paying more for ingredients and materials, including cooking oil, steel, freight, fuel, and labor. The reason this has piqued my interest is that within the last several months, I've noticed that margins have begun decoupling from year-over-year revenue growth for many companies. This is very important to understand because as we move into Q3 earnings season, we're going to want to pay particular attention to margin guidance. Specifically, we need to remember that those companies who have the pricing power and can pass cost increases along to customers will be your winners. Companies that are forced to eat their cost increase will fall to the wayside. Today, we're going to look at how rising costs are pressuring the margins of food companies, and I'm going to show you why not all food companies are created equally. Before we get started, please like, comment, and subscribe, and come back every week for more videos on investing strategy and making the most of Zacks Pro platforms. If you'd like to do the kind of analysis you're going to see in this video, then you need to have a ZAT Portfolio Manager subscription, which includes both the Zacks Advisor tools and the Zacks Research System. Let's go ahead and get started. Up on the screen, you can see that I've lifted an article out of the Wall Street Journal. This was actually an article out of the journal regarding Pepsi and their third quarter announcement last week. Articles dated Wednesday, October 6th, and interestingly enough, the thing that caught my attention was that Pepsi is actually lifting its outlook as sales rise. And this is something that we should expect because of the Delta variant and it's abating. So now the expectation is that we're going to be able to travel more, and with that comes more frequent stops into convenience marts to pick up Pepsi products as well as Frito-Lay snacks and among other things. So the interesting part of this article here, and this obviously sets the stage for our discussion, we're going to hop into the research system here in just a minute, but you'll see that it says PepsiCo will continue to pass on higher costs. This is highlighted here in yellow to consumers with price increases this fall and early next year. And this is from the CEO. And actually, that was from the finance chief. And the interesting thing about that I found about this article was that the comment that was made next from Chief Executive Ramon Laguarta, consumers around the world are more willing to accept price increases now that they were in the past. And he says, perhaps in part because they are shopping more quickly in stores and might not be looking as closely at price tags. I kind of chuckled when I read that, and something that I wanted to share with you. I certainly hope that it's more than that. We certainly are becoming more used to paying more for our goods, but I would hope that it's not just because we're not paying attention, because we certainly are. So at any rate, this was on Wednesday. And then on Friday, I noticed another article right on the cover of Business and Finance section. And it specifically mentions that companies like Conagra Brands, PepsiCo, and Lamb Weston Holdings are all going to be raising their prices to keep up with the costs. And so I figured after I went to Subway this weekend and saw that there was a $15 foot-long Pro sub on the menu, certainly we've all experienced these food cost increases, that we need to take a look at some of these food maker stocks. So what we're going to do is we're going to use Conagra, PepsiCo, and Lamb Weston Holdings here as the basis for our discussion today. So we'll keep it relevant. Three companies that were named right on the cover of Business and Finance just last Friday. So we'll move into the research system now. And the first company that we've got up on the screen is PepsiCo. And what I've done, we're just going to start with the price and earnings chart. I use this pretty much as my home page, and we're only going to talk about three different views here. We're going to show you how relevant we can make these three views very quickly when looking at the margin scenario. And the idea here is that we've got PepsiCo reported last week, obviously an earnings certain name, right? A member of the earnings certain portfolio, and just absolute rock solid earnings stability. And when you compare that with Conagra, right, you can see it's much more cyclical in nature, right? So Conagra is going to own your brands like Slim Jim, Marie Callender's, Orville Redenbacher's, brands like that. And then when we get into Lamb Weston Holdings, I want you to think of frozen potato products. So this would be to both restaurants as well as resellers of French fries, hash browns, those sort of things, tater tots. And again, you can see going into a massive, massive trough here. Really not enough history here to determine how cyclical the business really is, but certainly took a beating in COVID when all the restaurants got shut down. So anyway, we're going to look at all these. Notice that Lamb Weston has a strong sell rating, and I believe the remainder of the two were holds. And we'll look at the earnings revision trends here in just a minute so you can see that as well. So when we look at Pepsi and we take a look at their margins, and again, we're just going to go to my favorite margin analysis view. Revenue trailing 12 months, we convert that to a 1-year percentage change. And the interesting part that we want to pay attention to here is whenever we see signs of any sort of decoupling. And we want to pay particular attention to how each of these companies is in fact making up for these increase in costs, okay? So we already know that based on the articles out of the Wall Street Journal that all three of these companies are going to be raising their prices to keep up with costs. But what we want to do is we want to pay attention to what the normalized revenue growth was prior to the pandemic. And you'll see that for Pepsi, it was clocking in around 3.5%, 4% pretty consistently. And it was actually able to sustain that level, and it's actually been accelerating as of late. We've got literally 10, 11% revenue growth here. And what's interesting to note is that even with that revenue growth, right, our gross margins have just absolutely started cascading. And notice that the scaling makes it look a lot more extreme than it really is. We're really only going from about 55% down to 53%. So I want you to think about that is basically for every dollar that's brought in, you've got literally 55 cents at this point was more or less gross profit, all the way down to about 54 cents here currently. So not as extreme as this looks. Certainly revenue growth doing a nice job to try to combat some of those increases. However, notice that the revenue growth itself, even though it's clocking in at 12% year over year, 11.85, it's not enough to counter the cost increases because gross margins are still slipping. And what I want to mention here is the difference between a company like PepsiCo versus the other two companies we're looking at, Conagra and Lamb Weston Holdings. The difference is obviously management's ability to, and we'll go back to the price and earnings here, management's ability to basically maintain this earnings trajectory, which is so critical for these types of stocks to be able to stay in the earnings certain portfolio. Recall that ECP stocks themselves, the management teams, they're just impeccable with their ability to maintain this earnings trajectory. And certainly PepsiCo fits the bill, and you can see exactly what they did to maintain their margins, right? Remember that the difference between revenues and gross margins is cost of goods sold. So if we've got a 12% revenue increase and we've got gross margins plummeting, we know that, I shouldn't say plummeting because of scaling, it's more of a cascade, if you will. We know that that increase in revenue growth was not enough to offset the increase in costs, or this would be straight. Okay, that's what we want to see. So Pepsi is doing the right thing by saying, hey, even though revenue growth is up 12% year over year, we need to raise prices again, right? We need to boost revenues further in order to combat what's going on here with the slide in gross margins. Now, this is where we actually decoupled right here. Okay, you can see that inflection point where revenues literally took off. And at that point, we actually had gross margins slip at a faster rate. You can kind of see that inflection here, and it actually starts tapering down at a little bit of a faster clip. And so what's happened here all throughout this COVID pandemic, you'll see something very peculiar and something that is really, really a good sign of management's ability to control their costs. They basically stopped the bleeding at the operating margin level. And they were able to do that. Remember that the difference between your gross margin line and your operating margin line is primarily SG&A and R&D. Okay, so they were able to basically cut costs, and they've been doing it for quite some time, right? Because this has been on the decline for quite some time, probably a year or a little bit more. And so they've been actively cutting costs, stripping costs out of SG&A and R&D to keep that operating margin essentially flat. It's literally sitting, it's sustained at about 15, 16%. Okay. Now, notice that the net margin has slipped just a touch, but keep in mind that the scaling makes it look a lot more severe than it is. We've literally just got some non-operating either income, expenses. It's most likely going to be expenses, obviously, because we're on the decline, or something related to taxation that's just chipping away at net margins a little bit here. But again, the real story here with Pepsi is its impeccable ability to stop the cost bleed at the operating margin level. And so the idea is that Pepsi now going to be increasing their prices and driving additional revenue growth to combat what's happening here at the gross margin level. And you can see how this plays out not only with their net margins, but obviously when we start thinking about net margins, we need to start considering what's going on with estimate revisions, because in effect, it's the net margins themselves that are driving these estimates. Okay, and you'll see that that is in fact stable, right, and has been for months. And as a matter of fact, in F2, you can see that it's actually on the rise a little bit. So this is something that we would expect to see from an earnings certain company. This type of revision history for an earnings certain consumer staple brand is exactly what I would expect to see. Just a nice, slow, steady increase in EPS estimate revisions to the upside. Notice it's got a Zacks rank of hold. All the underlying estimates, not a whole lot going on is basically what that means. But at any rate, definitely speaks to the quality of PepsiCo's management and their ability to control costs, and that's obviously reflected here in Pepsi's long-standing price trajectory as well as earnings trajectory. So we get something a little bit different when we shift gears to a company like Conagra, right? Much more cyclical, okay? And so when we look at the margin analysis, we've got to pay particular attention to these trends prior to the COVID pandemic and then what's happened since COVID. And you can see that earnings growth that we saw throughout COVID was primarily driven by cost cutting heading into the pandemic. And we can see that because revenue growth is actually on the decline. So I want everybody to pay attention to this, right? So this is really, really good management. This earnings growth that we saw through COVID was a lot to do with cost cutting. And you can see that here in the net margins, okay? Look at this net margin increase, right? We go from 8.89 pre-COVID all the way up to almost 12%, all right? So it looks like we cut a lot out of operating margin. So a lot of SG&A and R&D type expenditures were cut out immediately when COVID struck, which was good planning by management. And they were actually able to cut some of the costs out of cost of goods sold as well, because you can see gross margins actually increased by about 1% or more. It was interesting that this was all happening at the backdrop of a decline in revenues, right? It's almost like they saw this coming and they were able to cut additional costs out to more than offset this decline in revenues. However, now this revenue decline is catching up with them. So let's take a look at this decline in revenues because it's material, right? You got 28% year-over-year percent change in revenues at the end of 2019. You can see that once COVID hits, right, that gets knocked down to 16 3/4. I'm just reading these numbers right here as I'm, and if you do a right mouse click and you do hide data, you can display the data. That gives you this probe that you can just drag along and see these values. But what I want everyone to see is that we're cascading down. We're down to 15. Now we're at 12 3/4. Now we're at 9.5. This is an interesting inflection point here because we actually pop up and you can see that it actually hits the pinnacle of gross margin inflection, operating margin inflection, and net margin inflection. And then we get a serious rollover in year-over-year revenue growth. We go from 13% down to roughly 1.18. And this may correspond with the Delta variant. All right. So that's a huge, huge slide. And with that comes the rollover in margin. So this is the one scenario that I always warn everyone about. And you can see now that year-over-year revenue growth is actually trending negative, and it's basically pushing down all the margins. So this is what I call a traditional margin rollover. And it's important when you see these things to kind of back up and take a look at how this fits within the overall margin trend. And you can see that we've obviously been here before. and Conagra has been able to get out of it. So that's a good thing. Remember that margins are cyclical. They tend to roll with the business cycle. And so it looks like, based on that Wall Street Journal article, that Conagra is going to get ahead of this. They're going to go ahead and raise their prices. They're going to need to raise their prices substantially in the face of a decline in revenues. We've got to hope that this Delta variant is going to turn things around for Conagra. When they increase their prices and drive these revenues, I would hope that these lines at least straighten out, if not inflect again and start turning to the positive. So that's what you're going to want to watch for with Conagra. But in the meantime, what I want everyone to pay particular attention to as we move into earnings season is how this type of scenario with this type of an inflection, right, in not only revenue growth, but this rollover in gross margins, operating margins, and net margins, how that actually hits the EPS estimates, right? So this, again, Conagra is not part of the earnings certain family. And you can see that its estimates have actually been revised down, okay? So they're struggling, and we just have to keep an eye on Conagra and see what happens with their ability to actually pass those costs on to their customers in the form of those price increases. All right, let's focus on the third company now. We'll go back to price and earnings, and we'll look at Lamb Weston Holdings. All right. So again, whenever you see this here, I've got a 20-year history. Obviously, looks like they just went public here right at the end of the year in 2016. We don't have a lot of history. The only thing we have is how they performed basically going into COVID, and we can see that that it looks as though consumers ate a lot less potato products, maybe visited McDonald's and a lot of the fast food chains. Although I don't believe that Lamb Weston supplies McDonald's with their potato products, but they very well may. They supply a lot of restaurants and obviously resellers of potato products. So at any rate, we can see this massive decline in earnings, and it actually currently has a Zacks rank of strong sell. So this one's got my curiosity piqued, again, right off the back of that Wall Street Journal article from last Friday. And again, what we want to do is pay attention to how this company was performing pre-COVID. And we can obviously see the decimation that took place during COVID, right? We went from positive year-over-year revenue growth on a trailing 12 basis of over 9%. And again, I'm just looking at this number right here, year-over-year percent change. And you can see that as COVID progressed, we literally just cascaded down to roughly a decline of 11% year-over-year. And this is our inflection point, right? So as revenues declined, so did gross margins, right? So did operating margins, so did net margins. And this net margin decline was significant, right? It was literally net margins got cut in half. We were almost at 13% net margins. So if you bring in $1 in revenues, literally almost 13 cents was getting down to the bottom line. And that got cut down to currently a low of about 6.83. So call it 7 cents on every dollar versus the 13 that was at the end of 2019. So we've got some warning signs here that we need to pay attention to. And the biggest one is not only this trend here and this inflection point. I like to see this rebound, but this is where the decoupling takes place for Lamb Weston that we got to pay attention to. And you can see it illustrated perfectly here. The revenue trajectory is going in the right direction, but now we've got these increased pressures on costs that are just absolutely turning the gross margin to basically roll over at this point. Same thing with operating margins, same thing with net margins. Okay, so a really, really good idea at this point for Lamb Weston to try to pass along some of these cost increases to their customers, because it's literally trickling straight down to the bottom line, and you can see that. So anything they can do to cut down SG&A and R&D as well will help. But when we look at the FY1 EPS, FY1 and FY2 EPS estimate revision trend, you can actually see what's going on. And these estimates are down substantially. We're talking 43% from October of last year. So basically the estimate for FY1, which is May of 2022, back on October 31st of 20 was $2.81. And you can see that monthly revision to the upside, actually, all the way up until June of this year, and then just absolutely cascading down to $1.59. And you can see similar activity here for F2, which is May 2023, but it's only down 10%, right? So still got a lot to work out, still got a lot of time for FY2. At any rate, remember that as we move through earnings season, right, we need to pay particular attention to the guidance issued for these margins. Remember that those companies who have the pricing power and can pass these cost increases along to customers will be your winners, right? Companies forced to eat their costs increases are going to fall to the wayside. And again, when we're looking at these charts, specifically the margin analysis view, it allows you to basically digest a complete income statement graphically with a line chart. And you're able to see which companies are able to pass those cost increases along to their customers. You want to look for this rise in revenues. You want to see revenues continue to increase. And obviously, worst case scenario, you want to see gross margins flatline, okay? If gross margins can't flatline and they're forced to eat some of those costs at the gross margin level, then you want to see them be able to cut their costs at the SG&A and R&D level like Pepsi did and make this operating margin flat to defend what you see here in the net margin, because it's the net margin that drives your EPS estimate revision trend, okay? And that's where Lamb Weston is really getting hurt. When we go back to Pepsi, we will look again at the scenario that is ideal and is what we would expect out of an earnings certain name, okay? So Pepsi doing the right thing, recognizing that perhaps this gross margin slide is going to continue, right? Gas isn't getting any cheaper. It's not getting cheaper to transport anything. Materials are getting more expensive. So now it's time to increase prices again. And although while this gross margin was slipping, right, here's that flat line and operating margin that I was talking about. Basically, Pepsi's management team defending that precious net margin line here. So this is what you'd want to see to basically provide that stopgap to more or less protect your EPS estimate revision trend so that you don't have those negative revisions, okay? So all that to think about here as we head into earnings season. That's about it for this week. If you found this video helpful, please hit the like button below and be sure to subscribe for future videos. If you have any questions or ideas for future videos, please leave a comment below or email me at tnyland@zacks.com. You can also follow me on social media. I'm on LinkedIn and I'm on Twitter at Tim Nyland. If you're interested in getting started with Advisor Tools or ZRS, or if you're looking to upgrade your current subscription, please contact our world-class support at Advisor Tools at Zacks.com and ZRS at Zacks.com. Thank you all for watching, and I'll talk to you next week.